Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money-colored commentator, Steve Savant.
Well, welcome everyone to our money tips for the new year to help us get on track for 2016. And here to bring us up to speed is registered financial consultant and investment advisor, Ted Meyer. Welcome to Right on the Money, Ted.
Thank you. Welcome.
And Happy New Year to you.
As you too.
Well, last week we talked all last week on debt. It was kind of somewhat depressing, but we kind of got through it. I want to look at our taxes. On our first segment, we're going to talk about money tips. And one of the biggest is I'd like to keep more of my money. So we had to think about tax management. But I'm looking at this history here. Personal income tax history, actually, in comparison to when we started paying income tax, thank you, Teddy Roosevelt, we actually, from 1914 till now, we're paying pretty low rates.
We're on the lower end of it. Yeah, historically, we're at historically low levels.
Think about this. We're in a marginal progressive tax bracket. And everybody says all the time, how do I know if this tax product or this tax advantage investment, how do I know if it's really impacting me? Well, I don't know until I find out and discover your effective tax bracket. I don't know what your deductions are, your exemptions are, your tax credits that you use back on. I don't know if you're using adjusted gross income, which is at the bottom of the first page of the 1040, or we're actually subject to modified and adjusted gross income. I don't know. I have to do the math. But once I find that out, I can kind of find out where I land on this tax bracket.
Exactly. Having a marginal tax bracket is a little bit different. Most folks go in there and they think that if they're paying X amount of dollars and that equals a 25 or 28% bracket, that's what their rate is. Mm-hmm. The effective rate you just talked about is a big difference because as we step up, the rate's actually a little bit lower. So,
and by the way, if you want to say, hey, Steve, I need this for 2015 for my taxes in 2016, if you want to just write me at steve@rightonthemoneyshow.com, I'll send it to you. I'm looking at the differences between the 2015 and the 2016. Not much difference here. There was not much of change, a little bit, but not much.
A couple of dollars changed on the married filing jointly, things like that. But overall, the rates are the same. The dollar amounts just changed a little bit.
Now, your practice in Arizona is really centralized around the boomer community, and yet you're an Xer. Do you feel sometimes there's a generation gap in the way you have to approach guys like myself who are baby boomers?
A little bit. When we look at things from a Gen X perspective versus the baby boomers, I think we get a little more detail on a few things. And from that standpoint, we find that the boomers are looking for a little more constructive.
Trying to figure out what they want?
Yeah.
Think about this. If I'm a boomer, and I am, I'm looking for the most money I can keep. So taxes is the first issue. My second issue is my expenses. We'll get into that in another segment. Everybody always talks about, I'm trying to manage my taxes. This is the first place I go.
Yeah, first place you go is looking at your taxes that you're paying. We're going to be coming into tax season here shortly, April. It's the end of the year. Everyone's going to start getting their statements. They're going to look at the taxes that they paid on stuff. And so what we want to look at, one of the first areas is your interest and dividend income that you're getting. A lot of folks aren't using that money for income, but yet they're still paying taxes on it. So there's an opportunity there to find a way to defer those taxes out if you're not using them.
Okay, so let's just walk through that to make sure everybody understands. So there's money that I'm not using. I'm using it today. I'm still paying. If you have your money in CDs, it's terrible. I could go out to bankrate.com to see if there's anybody paying you a little bit more, maybe a little bit more, no brick, no mortar.
Yep.
I don't have to go to an actual bank, but those numbers are not there. And I have to pay taxes on the money whether I use it or not.
Exactly. The 1099s will come out in late January. You had a CD that was paying you a whopping maybe 1% last year, and now you're going to pay tax on that money. That's a 5-year CD. You're trying to roll it forward. It makes no sense to pay that kind of tax.
Now, what about the dividends? You know, people are making dividends off their fund, their non-qualified funds,
non-qualified
stocks,
fund dividends.
Things of that nature.
Well, with the dividend section on that, if they're not using the dividends, obviously they're reinvesting them.
Mm-hmm. I'm thinking of one of the big things where we're going to face in about 2 weeks. Many of us are going to be receiving our statements from our mutual funds, our ETFs. And some people have experienced losses. And by the way, if you didn't catch some of the things that we talked about prior to the close of 2015, we might have been able to mitigate some of that by doing tax harvesting tactics and strategies.
Right.
But kind of too late for that now.
It's too late now. We're December 30th.
You can just do it for this year. But let's just go down this. We're going to receive our statements about the last week of January for the fourth quarter, or i.e. the end of the year.
Correct.
All right. We're going to get this. And I have many clients, and I've been doing this for 32 years, and I'm shocked. My client says, Steve, I had a couple loser mutual funds. I'm reviewing it for him. And he goes, but a week later, I received a 1099. How can I have a taxable event on a fund that actually showed a loss?
Yeah, this is one of the misconceptions a lot of people don't realize. If the fund loses money, that doesn't mean that every single investment inside the fund lost money. They have sold out. The investment advisor, fund manager may have sold out of that sometime in June, July, August, showed a profit on that specific stock that they had inside the fund. Even though the fund overall lost money at the end of the year, you're still going to get a 1099 on every single stock that actually made money that year.
So
it's kind of a double whammy. You lost money on the stock, and now you're paying. You lost money on the fund, and now you're paying tax on it.
So just to make sure I understand the educational side of this, so my mutual funds have an inventory of many stocks.
Correct.
Okay, and the overall mutual fund all over probably lost, could have lost, but I had some winners in there.
Very correct.
And I still have to pay gain or ordinary income or whatever it is.
Correct.
Right. I have to pay taxes on that.
Yes, that is
Okay,
true.
see, I think most people are like me. I'm just thinking, how can that be? I have a loser fund, and I lost money. I still had to pay the fund expenses, and now you're telling me I have a tax bill.
Yeah, that's what happens on the mutual fund side of it. And as you go forward and you see these, when you get your statements coming here in January, take a look at them.
Yeah, I think we need to not only take a look at the 1099 statement, but you have to make sure that you match this up correctly, and then you need to become proactive. This is the biggest issue. Okay, we missed 2015. Let's start thinking on how we're going to do this in 2016. So if I'm working with an advisor, and of course I recommend that you always work with a good advisor who knows what he's talking about. And I need him to know this up front. I want you to mitigate taxes. There's some people, by the way, clients I have, that they say, Steve, I don't even care about taxes. I don't even get that. Yeah. But let's just say we're now up to speed, and most clients want to have the most money they can have. Let's think about judiciously tax harvesting at the end of 2016 so that we don't have to talk about this. Now, last thing, if you say, Steve, I saw this, and if you say, I need to really think about this, I don't think my advisor's doing taxes, I don't think he's up to speed on it, then that's the time when you need to think, hey, maybe I need a second opinion.
Correct.
I want to go to this next thing. This is this whole new thing for clients. They don't know anything about this, and this could be a boom, especially if you're upper middle class to affluent. This thing called qualified longevity annuity contracts.
Yep.
Now, the government is involved in this.
Correct.
They picked one product, and it's the only suitability product you can use. It's called deferred income annuities. What's that all about?
And deferred income annuities is just a place where you'll park some money for a certain period of time. And inside the QLAC, what you can do is you can take part of your IRA, and instead of, from a lot of our clients, they don't want to pay tax on their IRA. It's additional income that they find a way to somehow move to the sidelines. You can use the QLAC, park money in there, and defer taking the income on that up to, I think, age 85. Now, you can only do it on 25% or $125,000 your balance, which everyone's less because you're capped on it. But this is a nice way for you to take part of your IRA distributions that we do have some clients that come to us and say, I don't want to take any of this.
I don't
between
need my
Social Security,
RMDs.
between my income, my pension, I don't need my RMDs. What do I do with them? So some of them take them and give them to their kids. Other folks say, I'm going to use this QLAC, and I'm going to defer payments on this.
And just keep in mind, remember, required minimum distribution, 70 and a half, there's a major penalty. If you're getting up around that age, you need to make sure your advisor's up to speed on your birthday and the law. Now, this QLAC, this qualified longevity annuity contract, uses a deferred income annuity. That deferred income annuity you can stall or forestall RMDs. So you could even ladder this. You could buy some that begin at 70, 75, 80, 85. So I think this tactic is really great. Now, again, I think most people that are middle class and below are probably not going to use it. They probably need the money. Yeah, so they're probably not going to see that. Now, so in your thinking, when you do this, have you started using this? Because this is relatively new.
QLAC just came out, I want to say probably second quarter of 2015. It's a brand new concept. A lot of folks are asking questions on it. We've done a few cases. There's very few carriers out there that recommend it. But it's basically gives you the opportunity to defer payments. It's not really an income producer for you. It's not really a growth vehicle. It's just simply taking the income that you're supposed to take for your RMD and deferring that out. So it's very specialized, but a lot of folks have a lot of interest in finding out about it.
Well, I like the ability to control my
That's
destiny.
what it is. It's controlling your destiny.
And it sounds like, and I think I heard you say, I can take up to 25%.
Or $125,000.
Or $125,000.
Less.
Whichever is less. And that's mother and father if you're married.
Correct.
Unbelievable. I want you to remember what the good Reverend John Wesley once said. Make all you can, give all you can, save all you can. I'm Steve Savant. We'll see you next week.
For more information on this week's money topics, just go to our website at www.rightonthemoneyshow.com and follow Steve's daily postings on Facebook, Twitter, and LinkedIn. When it comes to retirement, money management, small business, insurance coverage, college funding, or budgeting, we have the interviews you can use.